Hey everyone, welcome back to the channel. Today we're going to finish up looking at Etsy. If you didn't watch the last video, we projected out their revenue, and we did it kind of two ways. The first one was just looking at how we thought GMS on their platform was going to scale. From there, that got us our marketplace revenue. And then we calculated service revenue based off the number of sellers on the platform and the current amount of revenue per seller from that aspect. So services revenue per seller. And then the second way we looked at it was we looked at the number of new buyers that they're adding every year, and then layering in a customer churn amount, and then the average amount spent per customer. And that gets us another set of revenue numbers here. So those were kind of the two ways we really looked at this. And from this, we end up getting, anywhere in a decade from 10 to about 11.5 billion. So that'll probably be the sensitivity area I use here when we look at it. But now to round out the DCF, so for now I've linked this up to the lower revenue projections, so the one that goes to about 10.2 billion. And then everything in green here is the historical data that we have linked up. So we'll just have to build out some of the final projections here down in the bottom. And then we'll see what kind of valuation we get, and then we'll check that back compared to Etsy's current price. So the first thing here is cost of goods. I think this is a tough one. Just kind of looking at it, it's been all over the place, right? I mean, it's averaged 29%, but 27, 31, 32, 26. If we actually read in the 10K, they actually say that based off the mix of revenue, this could shift. And if they have more kind of payment processing revenue, then it's going to be lower margins, so higher COGS as a percentage of sales, which was kind of the opposite of what I was really thinking here for 2020. So if we look at 2020 revenue, it was mostly marketplace revenue. So I would think that that's going to be more of the payment processing revenue would be incorporated in there. And then the services revenue was obviously lower. So, I thought that we would have seen the opposite thing this year. So the 10K doesn't quite match what I'm seeing intuitively. What I'm seeing here is kind of as service revenue makes up more of the total, or as marketplace revenue makes up more of the total revenue in comparison to service revenue. So it's about, 1/3 the size of marketplace here, whereas about a third here. I guess it's kind of stated. I mean, there's a quarter. And if we look, right, margins were better here. So I guess the way I'm going to think of this is as this top line marketplace revenue gets bigger and bigger and service revenue becomes less of the total pie, then from that standpoint, I think margins, stay the same or get better. Just kind of what I've seen, looking historically here where margins were better and it made up a smaller percentage of it. And quickly, I can add a formula here so we can just look at, how this margin profile is changing over time or I guess revenue mix is changing over time. So we can see, right, service revenue was really high in 18 and 19, and cost of goods was a bit higher. So, I think intuitively, like this makes sense for me when I kind of look at it, but maybe for now we'll just leave it at 26, and we'll do that for the first 5 years or so, and then we'll actually have them shave off 1% at that point, just because as they get larger, oops. So nothing, I'm not making any crazy assumptions here. Nothing crazy around the margins getting much better or worse. Marketing as a percent of sales, right? It's been going up. And I think to continue to drive these sales, right, it's going to have to continue to grow to stay relevant and to have people buying on Etsy. So I think this stays as a constant percentage in my mind. As a company that's trying to grow fast and get new users, I think they have to be aggressive in their marketing. I don't think that's going to slow down. Product development, this is an interesting one because in 2020 it dropped off, but I think that's also during 2020, companies didn't really know what to expect with COVID, so it was kind of like go into cost cutting mode if we could. So from that standpoint, they're like, maybe don't work on product development and let's, stop. But I think it's going to go back to pre-COVID levels if I had to take a guess. That's just kind of my idea. And then SG&A, so this is interesting. It's improved every year, which I think we should see But at a certain point, it should probably stay about flat. So obviously they here, right, 17%, they probably had pretty big corporate structure for the size of revenue they were doing. So you know what I mean? They were staffed as if they were having more revenue than they had because they're this high growth company. And as, revenue's grown, if we look at it like, yes, G&A costs have still grown. Um, I mean, except for like this, whatever this dip here was, but from 18 to 20, right, it's grown consistently, but the percentage as total sales has gone down. So I don't know where this stops, maybe around like, let's call it like 6.5%. And then at that point, right, as sales grow, you're going to hire people as you kind of need them to kind of support the organization. So I think, there's probably a little bit of room for this number to continue to go down, but it will flatten out eventually as a percentage of sales, unless if they go do some crazy cost-cutting measures and drop all of this stuff. But I think that covers kind of most of our assumptions. Tax rate, this is just set to the corporate tax rate of 21%. CapEx is a weird one here. So the CapEx numbers they report are like pretty low. It was high in 2016, but 13, 21, 15, 7. And then the D&A expense they're recording is, like double or triple this. And reading through the 10K, it looks like they have um, their lease costs for their buildings incorporated in this D&A. They're amortizing the cost of the lease now in there, and they don't really like back it out. So it's kind of wonky. And the best they give us is they do give us a little bit of a schedule where it was like D&A on property and equipment, and then amortization of capitalized website development. But even then, you can see like that's still 32 of D&A, and that's still higher than the 27 they report on the statement of cash flows. So I'm not entirely sure what's going on there, and I didn't spend too much time trying to figure it out. But my thought is it looks like historically CapEx for purchases of property, plant, and equipment, except for 2020, was about 2%. So I'm going to set that to 2%, and then I'm going to set this at 80%. And the reason for that is I think the historical data has a lot of these weird items that we would adjust out of D&A if we had like a full schedule to see what the heck's going on there. But we just don't have it. So from that standpoint, I think we setting 80% is kind of saying like every year you're going to spend a little bit more on D&A than you did the previous year. And that's kind of like just a good base assumption in a growing company. Last piece is stock-based comp. So if you look at these numbers, these actually exclude stock-based comp from 2018 onward. So you'll see if you follow the formula, it's E7 minus E28. So E7 will give us like the marketing, and then E28 is going to be the marketing cost of stock-based comp. So I've backed it out. So we do add it back here to get unlevered free cash flow. But I think 4%, historically 5, 6, 5, 4. This might tick up to 5%, but we'll be conservative here and call it 4. And then working capital, I don't like to have a company generate massive cash flows from working capital, to be honest. So when you just kind of set it to the prior year as a turn, you get relatively low impact of working capital cash flows. So this model here in the WACC we have is 10.4. So I have a WACC video. We calculate WACC actually from 10.4 to 13.1. I think 13.1 is probably better because it shows a riskier environment that this company is operating in. So that's kind of my thought there. And I've sensitized here from 7 to 13, so we can kind of just see, depending on the perpetuity growth and the discount rate, you get anywhere from 15 billion to 47 billion valuation. So this is with our lower revenue numbers. And actually what I can do here, I'll just rename this. We'll call it bull. I mean, it's not super, to be honest, it's not super different. We'll get a little bit of a different valuation, but right, 18 to 55, so nothing crazy. And if we look at, I actually don't know what their current stock price is or market cap. I'm gonna guess it's probably market cap 22 billion. So yeah, I mean, surprisingly, right, if we go with our kind of base case, and we go with our 13% whack, slightly overvalued. But if you do if you do the 5-year whack of a 10%, then they're kind of like fairly valued based off this model. Now, um, with that said, our revenue, I have left revenue growing off of 2020 numbers. So the reason for that is in their Q1 filing, they've continued to see the momentum they saw in 2020 through the first quarter of Q1 or the first quarter of 2021. Now, the question is like, is that really going to continue when the economy is back open and fully swinging? And by economy being open, I mean like your local economy. Like you can go to the mall, you can go out to the farmer's market, you can do all these things, right? I think that's the part to be seen. I think throughout COVID, there was this big push to like support local and small business. And Etsy was this platform that could really take advantage of that, of where local, it's local artisans from around the world selling their products on our marketplace. And right, they sold $1.5 billion in masks roughly on their platform. So, you know what I mean? Out of the 10.3 billion, they said, let's see, I think it was like page 74 in here. Um, where is it? It's page 70 something. GMS excluding masks was 8.7 billion, right? And if they did 10.2, 10.3 billion in GMS, that means they did 1.5 billion of masks alone, right? So now we're saying in 2021, right? I'm sure they sold a few masks in Q1. Probably not anything crazy, but I'm sure they still sold a handful. But people are going to stop buying masks. They recognize this. They mention that. So for them to still grow GMS 2 billion, it's really growing 3.5 billion, right? Because they're going to lose a billion five of mask sales. So then you're saying you're really growing your GMS almost like 40% excluding masks, right? You're going from 8.7 to 12.5. So in Q1 they were on pace. I think they had like 3 billion of GMS in Q1, something like that. So that's kind of why I was like, this seems high, but it seems reasonable. So I guess the question here is, can they sustain this GMS and revenue growth, right? So if we come here and let's just call this bear case, um, and I'll show you, like if we come here and we're just gonna change some of these real quick. If we say, okay, you're going back to, we're gonna give you the midpoint, right? So we'll just give you the average of 20 and 19. And then from there, we're gonna have you grow, call it, whatever growth rate we pick. And let's say historically they've probably grown pretty high, but it's a smaller base. Let's say they get kind of right, if we go back to those levels, you're not going to get anywhere near the valuation you need if they're just growing as they did in 2018, right? Now you're going to say it's a $5 billion company. And, what happens if we say, yeah, what do they got to grow at? I'm kind of looking at this 13% whack line here. At the 10% whack, right? So if they can grow 25% a year after normalizing out in 2021, right, then sure, with everything else being constant. Um, then on a 10% whack, then they're probably fairly valued. But if we're looking at the 13% based off a 3-year beta, right? I mean, you're probably gonna have to grow what, 32% a year? You're gonna have to grow at 2019 levels, which, they did it in 2019, so I'm not gonna say it's not possible. But you gotta do that for a decade. That's gonna be tough. And that's even probably that's right, like our cases where we assume growth off of 2020 levels doesn't even get us there on the 13% whack. Um, so I think it's just something to think about and look at of if they can actually kind of continue this momentum and growth off this year, then yeah, there's probably a pretty good chance they're fairly valued. Question is like how much upside is there and how much risk is there, right? If you don't think there's much risk in this, then like, right, and you're like, oh, they're for sure going to grow off these COVID levels and a 10% whack is more than adequate, then they're undervalued. Um, so I think it's really a risk appetite thing, and how much you believe Etsy can continue this momentum. And I think for a lot of companies during the pandemic, 2021 is going to be this really crucial year for kind of building out models and valuations and saying like, what happened in the pandemic? Is it here to stay for this company, or was this just like a one-time blip? And like with Netflix, right? Like their subscriber growth was down in Q1 and things weren't looking good. And they're like, yeah, we just pulled all these people that would have joined this year into last year. So it's going to be different for every company, right? But um, it's interesting because it's an online marketplace. So once you kind of buy on it and you're comfortable with it, maybe you go back and continue buying there. So maybe it is a little bit different than a Netflix subscription. But I don't know. I guess time will tell and we will see. But um, yeah, I think it's an interesting company to keep an eye on and see how the rest of the quarters go, um, and see if they can kind of continue this growth. But I guess time will tell. So thanks for tuning in. Let me know if you have any questions or comments, and I'll get back to you. Thanks.